Education Academy. Today we're talking about, of course, with the Fed's update, a Fed update. In addition to that, lithium stocks and why you should be paying attention to them as an investment. Before we dive full in, we want to say we have about three new Panthers who have joined the group that actually invests with Leon and I. We're really excited about that. We're moving into a possible property in Morocco, and we're looking again back at Ghana, and we are definitely going to be buying land in a city close to ours. So I'll just say that. But we're definitely buying land there or buildings and some houses. So our portfolio is growing. Super excited. The goal is within the next, say, 3 years, to have $1 million portfolio of properties.
That's
$1 million portfolio of properties in 3 years or less. That will be the goal. So with that being said, I think we can hit that goal pretty easily. And for you all who have been involved in that, thank you. And since the beginning of this year, our portfolio has increased in value. About our investment stock, our stock portfolio has increased in value roughly about 16%. So that is great news coming off of where we were. But it goes back to time in the market will beat timing the market most of the time. So while Leon tells you why we chose the topic today about the Fed update and lithium stocks and why you should pay attention to it, I'm going to do a little homework. But I also want to say thank you to all of our members in our platform as a whole. And for those of you all who've been joining the Facebook community, we're continuing to grow. That's because you all are, coming over and joining the group. In addition to that, for those of you all who are searching Investing Education Academy on YouTube and watching our videos, thank you. It's pretty cool when people call us and say they were watching this over dinner. So that is definitely a cool piece.
Yeah.
All right, Leon.
Okay, so as just to kind of give a contrast of what Brent said. So to give a quick background. So with IEA, we have an investment. So Brent and I have our own accounts. We invest our own money. And then we have a company account where we invest money on behalf of IEA, the company. And that portfolio so far this year is up 16%. But I'm going to tell you because this year the general market is up about 6%. And tech stocks, which is the holy grail for most of us, is so our portfolio so far this year is beating general stock market by 10%, and we're beating tech stocks by 4%. So we're having a great year to start the year so far. We've reallocated some things in our portfolio this year. Likely, won't say it will. Likely, history is on our side. This year likely will be a good year. I don't know what that means, but I'm pretty confident in saying it will not be down 20 to 30% like last year. So, and we'll talk a little bit about why that is now too. So, just want to give a little return we're seeing so far this year. First thing is what happened today regarding why I am excited about our return so far this year. So, Mr. Jerome Powell, we've been talking about the Fed for I'm going on a year and a half. It's coming to an end, thankfully. So today he came out. They raised, so just FYI, they raised interest rates again today by 25 basis points. The federal funds rate, which you can kind of think of as the rate that prime is based on, that most of our credit cards are based on, right now is at 4.5 to 4.75%. So so when your prime rate, you add 3% to that. That's typically prime, and then you add another 3 to 6% to that is what we actually pay. So that's why if you look at rates right now, they're anywhere from like 8 to like 15% for anything, any sort of loan you're looking at. But the Fed funds rate is the basis for all that. So the Fed funds rate today was raised by 25 basis points. It's now a range of 450 to 475. That sucks generally because it's good for you. It's good if you're a saver. If you have if you're at CDs, bonds, things like that, those are doing real well. But for the market, it's not a good thing. But the good thing happened today. Jerome Powell finally, after almost a year and a half, let's say a year of raising rates, but a year and a half of talking tough, he finally acknowledged that what they are doing is working. And so when I say that, we last year we came on here every week and we were like, yo, the Fed, it was doom and gloom. Like it was like, oh my God, put a gun to my head, all that. The reason it was because Jerome, anytime the market would get an inkling of going up, he would come out and say, you know what, we're going to take rates higher. We're going to drive this thing up to 5, 6, 7%, and all that did was crush the market. Because real quick, the reason why, without going into details, when rates go up, stocks go down, and there's a reason for that. It's a mathematical formula. Basically, the future profits of companies are worth less. So just know that when interest rates go up, stocks typically go down. So anytime the market had an inkling of going up, he would come out and say, nope, sorry, y'all getting ahead of yourselves. We're raising rates more. We're going to jack them up 75 basis points, 50 basis points, telling the market to chill out. He would do that religiously because he did not want the market to go up, because what happens when the market goes up, you get this thing called the wealth effect. And that's where we as investors feel like, we get kind of chesty because we know we have this nice portfolio that's making all this money for us, and we go out and spend money. That's exactly what he's trying to stop. He's trying to crush demand. So what happened today, what was different was he came out and said, so he was asked explicitly by a reporter saying, hey, the market is up, the stock market is up about 6% for the year. The bond market is up kind of roughly the same. How do you feel about that? And that was the door open wide open. The door was open wide open for him to crush the market again and say, hey, look, the market's getting ahead of itself. We're going way above 5%. We're going to wait till inflation is crushed. He basically said, to the shock of the world, he basically said, look, I'm cool with that. I'm cool with the market going up as long as inflation is coming down and as long as wage inflation is coming down. And the CPI, the thing we've talked about on here many times, is the consumer price index, started out at like 9 point, I think it was close to 10 mid last year. And the one last month was at 6.5% CPI, consumer price index, basically inflation per year. So it's come down dramatically. He is encouraged by that. So he's encouraged by the CPI came down, and also wage inflation is coming down too. Wage inflation is just the amount of money that employers pay give the amount of money that employers pay their staff in increases, bonuses, things like that. The reason why that's dangerous is because the more money we have in our pockets, the more we're going to go spend. So he wants to crush wage inflation as well as general inflation. So this is the first time he ever came out and said, look, I'm cool with the stock market going up as long as wage inflation comes down and general inflation comes down, which both are happening. He also said, first time, that that they're actually not looking to. So there's something called a hard landing and a soft landing. A hard landing is when the economy goes into a recession, and that helps crush inflation. A soft landing is where you have the economy not going to inflation, but not going to recession, but inflation comes down without us going into a recession. He basically said today that he feels like we can go into a soft landing where inflation will come down. The inflation will come down without unemployment going up dramatically. So I'll say all this to say, Jerome Powell gave us I'm not gonna say it all clear, but he finally signaled to the market like, hey, I am cool with you going up. I'm cool with y'all having your party in the stock market. Do what y'all do. As long as inflation keeps coming down, I am fine with that. So back to the rates. They raised rates today by 25 basis points. There's talk that they'll raise rates possibly one more time next month in March, and then they may introduce what's called a pause. That's when they'll stop raising rates finally. They'll be right about 5%, and then they'll just hold it there for he's saying for at least a year. So rates will remain high. All of our credit card rates, car loan rates, mortgage rates, all those will remain high probably for the next year, maybe the rest of this year into some of next year, just because he wants to make sure inflation is crushed and we don't go out there and start spending like mad again. So that was really, really, really good news. The stock market, in my opinion, has run too far, too fast. I think what happened last year, especially in the fourth quarter, when everything just was, hell on earth as far as the market. I think we're kind of correcting some of that, but I think we're going a little too far, too fast. So I wouldn't be surprised if we do see a pullback in the market. Who knows when, but I think we're definitely due. We've literally since January 1, the market's gone straight up. Literally straight up. So I think we're due for a pullback. So say all that to say, today was a good day for us as investors. The Fed has signaled that they're coming close to an end. They're okay with the stock market going up as long as inflation comes down, and they're no longer like jawbone the market down the way they've been doing the last year, which is good for us as investors.
And for everybody who's listening, you still want to be very cognizant of what you're investing in. Still say avoid IPOs, avoid speculative stocks. If you're trading OTC, over the counter, that means that the stock hasn't made enough money to qualify to be on major exchange, but you can trade it over the counter. If you're doing that, pink sheets, all the speculative investing types. These are normally people who are doing day trading. If you have not mastered your system for day trading, which we don't support at all, but not saying it doesn't work for some people.
Right.
If for now,
Right.
it's a lot of things in business are gambling, but also too that this means that if you're looking at real estate, what's going to happen in the real estate market is normally an inverse relationship between the direction of inflation and prices for homes. So if we see the inflationary number start to steady, more than likely you will see the real estate market start to steady as well, which is really good because people, when they're scared, money doesn't move as quickly, which is, the Fed knows that, and that's why they're trying to control money flow. But, to use this real time and also for us to say we are still holding the position. Don't go back to the market thinking, oh, it's IPO season once again. You normally will get burned in that space. If a company is doing a stock split, unless it's in industry, that's hard to say. Energy industry.
I'm like industry.
No, energy industry.
Energy industry.
Yes.
Yeah.
You will see a lot of buyback programs for the stock. That's normal. I would say some other places like tech, if you see buyback strategies, sometimes, especially if the stock is trading under $20 a share, it's a company trying not to get delisted, and they're buying back their shares to keep up their stock price so they can stay on the exchange. That's a whole nother podcast, but just bottom line, don't go speculative thinking, oh, Leon and Brent said that the Fed isn't raising rates anymore, so I can go back to this speculative investing. That probably won't work for a number of years because of where we are in the market.
Now, I will say to Brent's point about speculative. So if you look at a lot of the stocks that did well during COVID, you'll see that they've run up too, right? And so, I mean, there's a fund called the ARK Fund, which buys a whole bunch of just speculative stuff. That fund is up 30% this year, and so a lot of people are like, "Oh, we're back." Hey, because they invest a lot of speculative stuff, and they're up 30% this year. But I, again, not trying to call markets. We have no idea what's going to happen. However, like Brent said, we're staying away from those type of stocks because, again, I think the market has run up too far too fast. I think we are due for a pullback. And once the market realizes that rates are going to stay high for longer, a lot of these speculative stocks will come back in. But basically, what happened last year, and this is kind of like known and not known. And Brent, you know about this. There's something called tax law selling. And so a lot of stocks were liquidated last year because all tax law selling is it allows you to harvest your losses and apply those to your taxes to lower your taxable income. Well, a lot of people got.
And Leon, let's give a shout out to Attorney Beverly Winstead, tax litigation attorney.
Yes.
She talked about that probably about 2 years ago about harvesting losses. And so shout out to her.
Yep, shout out to Bev. Yep, for sure. So what happened last year was, remember last year most everyone's portfolio was absolutely decimated. A lot of people had a lot of losses. So at the end of last year, I mean, if you go back and look, like December was horrible. I mean, they were killing Apple, they were killing like all the big name tech stocks that we love that are supposedly going to be around forever just got decimated. So what happened was a lot of people who sold those stocks took their losses and applied it to their taxes to lower their taxable income. Well, I think what's happening this year, and again, I can't prove it. This is just my assumption, is that a lot of that happened last year, towards the end of last year. What's happening this year is people are now getting back into those positions that they sold off, that they didn't necessarily want to get out of, but they just sold off because they wanted to lower their taxable income by taking those losses from last year. So I think that's why we're seeing this huge run up in the market in January. Not saying we're going to reverse and go back to the lows. I just think the fact that the market has gone parabolic since January 1 straight up has a lot to do with the tax issue from last year. So, but I do think, again, history is on our side. I think 98% of the time, when the year after a down year, the market is up a minimum of 14% the following year. So that's another reason I'm kind of confident this year will be good. And then based on how January started as well. So it's a little tidbit on that. And the second point I want to make is what our title is about lithium stocks. So just quick story what happened this week. General Motors reported earnings this week. And, GM is now moving hugely into EVs.
EVs, yeah.
And what they did this week was, which surprised everybody, is they invested $650 million into a lithium company, and this lithium company is a lithium miner. So they're actually mining the lithium in some state in the U.S. I forget. But so what that $650 million did is it locked in.
It's probably the Southwest. That's where a lot of the
Yeah,
runs are.
yeah, it was definitely south. Yeah, it was Southwest. I can't remember one of the states on the Arizona, Nevada, one of those. And so what that $650 million does for GM was able to lock in, and they get preferential treatment on any lithium that comes out of that mine. The reason this is big is because of we all know Tesla. Everyone loves Tesla. Tesla, of course, all batteries, EV batteries are made primarily of lithium and nickel. Lithium is one of the biggest inputs into batteries, and as everyone moves from combustion engines to electric powered, they're going to need batteries, right? And so a huge play that's happening right now is in the lithium market. And let me tell you how much lithium has gone up the last 2 years. From 2020 to today, through today, lithium is up $1,147 in 2 years. So we're talking over $500% appreciation over 2 years. And think about this: this is when the demand for lithium is just starting, because GM in the report, they've already started to produce some EVs, but they said they're actually not going to start ramping up EV production until the second half of the year. Same thing roughly with Ford. Ford is also kind of slowly getting this ramp up, and remember, every car they build, it needs a battery, and that battery is made with lithium, and that's why GM invested in this lithium company. Last point is that right now EVs are less than 5% of the cars on the road in the United States. And I think it's roughly the same in most industrialized countries around the world. So what does that mean? That means the demand for lithium is just getting started. It's up 1,147% in 2 years. Now imagine 5 and 10 years down the line, once all these, I don't know, between 10 and 20 car companies around the world all need lithium for their EVs. So this is why we're highlighting, letting everybody know. Look out for EV stocks. There are a lot of companies that either mine that mine lithium and or refine lithium, and we're going to be covering a lithium ETF and some lithium stocks inside our membership community either this weekend or next week. But we're definitely going to highlight some really good ones, and actually be highlighting one of the ones that GM actually invested in too. So
Yeah,
I'll just say all of our members, look out for that this weekend. If you're not a member, IEAMembers.com and join. Are you gonna say?
No, I was gonna say, and for those of y'all who are thinking, well, how do we know that's gonna work? Just read up on a little company, a little family called the Rockefellers. And when you think about the oil production, when it first started, everybody needed oil for everything they were doing, right? Some people went full in, some people didn't. The Rockefellers, they say, you know what, it's too much competition actually mining this oil, but we need a centralized refining station. And that's really where they made most of their family's wealth. That, and then life insurance, and then actual real estate. But so another thing. Bottom line is this: you have to understand, when you have I would say a global shift into a new energy sector, it takes tens, I almost want to say 100 years, but it takes a long time. Let's say 20 years for full adoption, right? You still have to get the infrastructure in place. You still have to refine the refining process. You still have to figure out what's the best way to, implement this new technology into the cars. You have to get the old cars off the road. You got to recycle them. It's such a huge undertaking that we aren't even close to where this market is going to be by the time we really, truly understand how to put these lithium batteries into cars in a sustainable fashion. So Elon was one of the first ones to, really go in that tip where he understood, I want to not only get into the lithium mine business, he started building his factories like on top of mines.
Literally. Like the one in, I don't know if there's one in the US or the ones overseas, but yeah, he literally built one of his, what they call the gigafactory, right on the same land as a lithium mine. Because, and he said, like Brent said, he actually literally said, if he was starting a business today, he would start a lithium mining company, because he knows the massive demand that's coming down the pike for lithium, into the future. And I believe lithium, correct me if I'm wrong, I'm not sure. I believe lithium is one of the most abundant metals on Earth, and we're just now starting to mine it. So the one that GM invested in, they said there's enough lithium there to produce 1 million cars, either per day or per year. I want to say,
It's definitely not per day.
okay, yeah, well, maybe it's per, maybe it's per year. But that's like over like 100 years. So I mean, it's just a ton of lithium that's at this mine here, somewhere in the U.S. And so so we're just saying, look, add lithium to your potential investments. It's very, very early. Don't we always say don't go huge into anything, but it's something. And again, it is speculative. But this is something that has a secular trend to it, meaning that this is actually a change in the economy. So it's not just about some fad. It's not just about the hot new thing. Multi-billion-dollar companies, car companies, are investing billions and billions of dollars into this infrastructure, as Brent said, that has to be supplied by lithium. So, like I said, lithium is up 1,147% in 2 years, and that's just as we're getting started. So,
and I think
FYI on that.
We've done a thing where we looked at the ecosystem of certain economies. I think this would be a great one to look at inside the community and kind of produce a report or some type of discussion around the entire ecosystem of lithium. So we should put that on a pin in that and actually do it as a live inside the group.
Okay,
I think that's cool.
That's good. Real quick, I see somebody saying the ARK Fund with a question mark. Just Google ARK Fund. It's ARKK is a symbol. And like I said, it's her the fund's manager's name is Kathy Woods. She invests in what she calls innovative technology, which in layman's terms is highly speculative companies without profits. So those are the ones we're kind of saying avoid. Now the stock, like I said, her fund is up 30% this year, but pretty much everything is up huge so far this year. Will it last? We don't know. Real quick, an example of why that might be dangerous is Snap, the app Snap, SNAP. They had run up big this year too. And then they reported earnings yesterday and dropped, I'm gonna say around 15% yesterday. Well, yesterday into today. So you got to be careful. So even though these things have run up quickly, when they come out with earnings or when maybe the market finally corrects, these things can plunge as fast as they rise. So Snap was a good example of that. It ran up into its earnings. It reported bad earnings and it tanked, I don't know, between 15 and 20% yesterday through today. So just be careful.
Yep. So with that being said, everybody, we owe the members 2 stock picks. So we will be putting that inside the platform. And just because we're talking about, it's been a good year to date so far as it relates to the stock market, that doesn't mean all of a sudden run home and change your portfolio or your asset allocation model or how you've been investing. It means pay attention to it. And for those of you all who've been on the sideline thinking, okay, I don't know when I'm gonna get in. When we've been saying throughout this whole thing, if you're picking quality companies, dollar cost average down, and now you would dollar cost average up. So for some of you all who are listening to this, going, but just tell me what to do. If you have a solid strategy, keep doing what you've been doing. Dollar cost average in. Don't go dump the farm in thinking this is going to be it. Leon and I talk a lot about false runs. This is not necessarily a false run, but we anticipate this entire year there are going to be a lot of runs and a lot of pullbacks, a lot of runs and a lot of pullbacks until we reach a place of somewhat steady growth. But that's also going to put us at the tail end of an election year. So we're right in the beginning of election year. So that brings its own complications. So anyway, continue dollar cost averaging, money that you can afford to lose. Don't invest grocery money, medicine, your mortgage, just money you could possibly lose, and reallocate those 401ks. If you haven't looked at your 401k in the last 200 years, please take a moment, look at your 401k, see if it's allocated properly. Because a lot of you all, when the market went south, you just put everything into a bond fund. And for you people in the government, I think this is like a G fund. And so everybody just moved everything to the G fund. If you did that, I suggest you look at your account. I'm not saying go crazy. Just look at a possible allocation that makes sense. And if you don't have anybody to talk to about it, you should contact Leon or I. Inside Investing Education Academy, we're talking about those government 401ks, 403bs, 457 plans. because it matters. So with that being said, Leon, you got anything before we go?
Yeah, I see someone else said something about China is investing heavily in lithium-rich countries. That's very true. Yeah, because I mean, China is the largest EV market on the planet, and so yeah, I mean, they need lithium more than anybody. So it's
Yeah,
definitely
and that's
false.
also one of the highest polluted planets. I mean,
Right,
countries.
right.
So they're
Yep.
definitely trying to move towards EV.
Last point I just want to make about the market so far this year. Remember, it's only January. We have 11 more months. We have a lot more time to go before. So it's been a great January. And like I said, history is on our side that it probably will be a good year. It'll probably be an up year. Let me say, I don't know about good. An up year. 1% isn't good, but it's an up year. So it may be that. But history is on our side that we won't be down another 20% next year. But just remember, this is only January. I mean, we have a long way to go. Who knows what's going to happen tomorrow, much less in 6 months. So yeah, just still remain, like Brent said, look at your portfolios. I would say, I actually said this in October. I was like, I feel like that was kind of like the low-ish time, and we've been kind of slowly adding to positions since then, and it's paying off huge so far. Like I said, we're up 16% so far for the year. The market's up roughly 6%. So we're a bit ahead of the game so far. So yeah, that's it. So yeah, like I said, look out for our 2 picks from today inside the membership community, and possibly this weekend we'll either be covering lithium related stocks and ETFs then, or maybe possibly on the hot seat Saturday, or if not into next week. But we'll see. You'll see this weekend.
All right, everybody, thank you for being with us, and thank you for joining Investing Education Academy. We hope to provide you with amazing information so you can start making money in the market.